Welcome to the amazing, nifty-difty, do-it-all asset protection planning tool you've never heard a good thing about and may run away screaming once I tell you. But I'll tell you what, if you do run away, you'll definitely be missing out. And more importantly, leaving your asset protection plan neither comprehensive nor effective. All right, I'll stop with that infomercial hard sell. There's no need to. And we'll let you tell us if you think that's true or not. So what is this tool that you've never heard anything good about? It's a cash value life insurance policy. Well, not just any old cash value life insurance policy, but a properly structured, properly funded index universal life insurance policy. Okay? With the right companies who have contractually agreed to deliver what they promise. My name's Kurt Jackson, asset protection planner with KJ Financial. We've found Index Universal Life Insurance to be the Swiss Army knife of comprehensive and effective asset protection planning. It's uniquely designed to almost single-handedly protect 3 of the 4 major and most neglected asset protection planning areas. Yeah, it's that powerful. So have I started this out and set the bar high enough for today's video? So why is Index Universal Life Insurance a key element to effective asset protection plans? Great question. The 3 most overlooked aspects of effective asset protection planning are taxes, stock market volatility, and the costs of long-term care. Hopefully you'll remember, as asset protection planners, we help prevent all known and unknown creditors from getting your assets. So the question on most minds is, why should these 3 areas be a part of an effective asset protection plan? Well, aren't taxes something we have to pay every year? Isn't your money an asset? So doesn't that mean that they're taking an asset from you on an annual basis? So would an effective asset protection plan want to address something taking your money annually to at least minimize it? Does the advice you get for reducing taxes tend to do that on an annual basis, or has your CPA or advisor sat down and looked at minimizing your lifetime tax bill? Annually, right? That's typically how everybody does it. Does it make sense to defer taxes on $1 today to pay taxes on $2, $3, $4, $5, $6 or more in retirement? How much lower would your future tax rate have to be for it to make sense to defer taxes, which is just postponing them, on $1 today? So if today's tax rate was 25% on that dollar, you're deferring 25 cents in taxes, right? Say in retirement you had $2. What would the tax rate need to be to pay the same 25 cents? 12.5% tax bracket, right? So it would need to be cut in half. How low would it need to be if that $1 grew to $5? It'd have to be 5%, right? Any chance at all tax rates are going to be that low for your retirement? Do you think with today's national debt, plus the unfunded promises for Social Security, Medicare, do you think future tax rates are going to be higher, lower, or the same? So do you think tax rates will ever be as low as they are today in your life, in the rest of your lifetime? Would it make sense to pay taxes one time on $1 at today's tax rates and never have to pay taxes again if it grows to $2, $3, $4, $5, $6 or more? Index Universal Life Insurance lets you do that. And unlike a Roth IRA, there aren't any contribution limits or income phase outs. So if you would rather pay taxes on the seed, 401k and IRA contributions, 403, 403b, 457 plans, rather than on the harvest, which is your retirement, Index Universal Life is a phenomenal tool to accomplish that in your financial life. Okay, so we handled taxes, right? So how about stock market risk mitigation? How much do we lose in the markets over time? Oh, I know they tout, the market is always up over time. And historically, that's true if you look at a long enough period of time. But what if you wanted to retire in 2003 after a 42% market drop from 2000 to 2002? Or what if you wanted to retire in 2009 after a 59% drop from peak to trough, 2007 to early 2009? Or how about wanting to retire in 2020, right? After a 33% drop in the S&P 500 from February 19th to March 23rd. Unprecedented drop. Is the market always up over time valid in those situations? Doesn't it depend on your timing? Do you know for sure your timing is going to be perfect? I don't. Does anybody? So one of the biggest reasons that we like index universal life insurance over whole life, universal life, or variable life insurance is we're able to grab market gains or index gains up to a cap or with a spread, lock into those gains annually and never lose a penny due to the market being down. Doesn't that start to sound like the best of both worlds? So did you know that since World War II, we've averaged a 33% loss every 6 years? We've had 3 crashes since 2000. So there's some proof in the pudding there, right? On average, in those bear markets since World War II, it's taken 1.33 years to hit bottom and 1.87 years to get back to even. So a little more than a 3-year period, right? So if bear markets have been averaging every 6 years or so, it's 6.14, just if you want to be technical. Doesn't that mean that about half the time your money in the market is earning a 0% average return if you left it in the market and didn't pull any of it out? Okay, so Index Universal Life helps to minimize taxes and protects your wealth from loss when the market drops while grabbing gains when the market or your index is up to a cap or after a spread. They even have the participation rates too. Thus addressing 2 of the 3 neglected risks in most asset protection plans. Pretty strong start, right? It gets better. Hold on. What about the 3rd? Long-term care expenses, whether it's in-home, assisted living, memory care, or nursing care. You know, many folks today don't realize the revolutionary change life insurance has undergone the last 4 or 5 years. Traditional life insurance only paid if you died. With term life insurance, or when you died with permanent life insurance, which is cash value. Okay. So while those were definitely valuable to you and your loved ones, certainly nothing to get excited over. You had to die for it to be used, right? But many newer life insurance policies, including some term life insurance policies, now pay living benefits. They'll pay a sizable percentage, as high as 90% of your death benefit if you have a terminal illness with 12 months to 24 months to live, depending on, that's carrier specific, whether it's 12 months or 24 months. Chronic illness, which means you can't do 2 of the 6 activities of daily life: eating, bathing, dressing, transferring, toileting, and continence. Basically, the qualifiers to be considered a long-term care need. They'll pay up to 2% of your death benefit per month for up to about 4 years, okay, in tax-free payments. Many also have a critical illness rider. So if you have things like a heart attack, a stroke, internal cancer, there's several more, they'll pay you a percentage of your death benefit in a lump sum, tax-free payment to help you pay for whatever you need it for. In our experience, you get the most of this benefit in the right type of term life insurance policy. So if that's a key part of it, we would want to add some term life to your plan. Index universal life policies typically, well, let's just say the ones that we utilize, offer all 3 of these benefits. So Index Universal Life hits the asset protection trifecta, helping you use pennies to buy dollars that multiply to do many of the necessary jobs in asset protection planning as well as retirement planning. Isn't it time for you to see how an asset protection plan would work for you? Hey, make sure you check out our other videos on our YouTube channel, Asset Protection Nation. Or, okay, if you're ready to get more information, there should be a box popping up here. You can click on that to register for our Asset Protection Nation Masterclass on-demand webinar. What a title, right? Which means that you can watch a recorded version of our webinar anytime you like. If you'd like to do that, go ahead and click that link that popped up. Hey, if you have questions that we didn't answer or new ones that our information may have created for you, please enter them in the comment section below. We do our best to try to address them as quickly as we can. And when we get really great questions, we might even do a video about it. Also, if you found value in our video, please share it on your social media and make sure that you click on the link that's going to be popping up to subscribe to our YouTube channel, Asset Protection Nation, okay, to make sure that you are first in line to get in all of our future content. So thanks for stopping by. I certainly hope we get to meet someday.